been producing the Westpac Red Book now for 13 years. It's basically a complete detailed wrap of the Australian consumer. It drills down into a lot of the rich detail that we have from our Westpac Consumer Sentiment Survey. That survey has been run since the mid-70s. It has an enormous amount of more granular detail on different perspectives, not just a headline index in there. We've got views around family finances, around the economy, around jobs, housing of course, and also these other measures around risk aversion and news recall that provide us a really rich data set. Plus we have measures, continuous measures, covering over 60 different subgroups. So there's a lot of nuance underlying that headline number, and it can tell us a lot about what's happening to the consumer, how it compares to previous historical moments, major downturns, recessions even, and how we can sort of make sense of that in terms of their behaviour. We also take a pretty deep dive on their activity as well in terms of spending, and it's pretty important for the wider economy. The consumer accounts for over half of domestic demand in Australia, so it's a really crucial part of the economic picture around both demand and growth in the economy at any point in time. So on the activity side of things, we also draw on Westpac's card data and very timely sources. So what we try to do is provide a picture as clear as we can up to the most recent point in time. So this is the October release, and we have some pretty good data up to that point. Well, the top view is pretty straightforward. Consumers are in a pretty bad place at the moment. Sentiment-wise, they are still deeply pessimistic, 20 points below neutral and the long-run average. And it's all about this cost of living crisis, and to some extent the rise in interest rates that we've seen over the last year, particularly for the mortgage belt. But we're seeing broad-based weakness in sentiment and not really much let up around some of these pressures. We really haven't seen much of an improvement since the RBA stopped raising rates 4 months ago, and even with inflation coming down from its peak of 8% last year to around 5.5% currently, that doesn't look to have done much to ease these strains on family finances and sentiment more generally. That may speak to what we call an asymmetry in how inflation affects sentiment. It's viewed very negatively when we get a sudden surge in prices and inflation, but as inflation starts to moderate, it's not viewed as positively, given that prices are still very high. And I think that's what we're kind of working through at the moment, that on the one hand, the inflation story in terms of growth is slow, but prices are still very high. The pressure's still there on family finances. And there's not a lot of, people aren't so convinced that interest rates have stopped their march higher. In fact, most consumers, 63%, expect mortgage interest rates to move higher over the next 12 months. So they're still bracing for more shocks around that interest rate side of things. So not a good read for October, leading into that sales high season in November and December, when we get the high profile tech sales and then the Christmas sales. It suggests that consumers are still going to be very wary of any price increases and their capacity to spend, and will still be looking to pare back on their spending. That said, all things considered, what we've seen from spending to date is actually a lot milder than what consumer sentiment's been telling us. We have indicators based on our consumer sentiment survey that have been pretty good predictors of spending growth historically. Over the last 12 months, they've been pointing to a contraction in per capita spending in the order of 3 or 4 percentage points. That's nothing like what we've seen. In practice, we've seen maybe half a percentage point decline in per capita spending. So consumers have been trimming this expenditure, but not slashing it. That speaks to another element at play at the moment that's not really captured by sentiment, and that's this pandemic savings buffer that got accumulated 2020 and 21 and a little bit in 22. And that's really cushioned a lot of the shocks that have rolled through family finances and allowed consumers to maintain a higher level than otherwise spending. But that's obviously not going to last forever. And we're starting to run down this buffer. And so the sentiment reads that we're still getting at the moment speak to some real concerns that spending could continue to remain weak near term and could be prone to weakness as that buffer really dissipates. Big contrast really to the wider consumer sentiment piece. And housing is a story of two extremes. On the one hand, we have a question that asks about whether consumers see now as a good time to buy a dwelling. And it's a picture of affordability issues for owner-occupiers in particular. And that continues to see some of the weakest readings we've seen overall historically. The index is at 76, average for Australia is about 120. So we are miles into the red in terms of whether it's a good time to buy. Not just that, it's the widest spread of negativity that we've seen historically. Since April last year, if we look across the 55 subgroups that we track on this measure, only one has registered a positive read since April last year. That's an extraordinary blanket wall-to-wall negativity for over 12 months now. That's a lot more negative across the board than we saw during the GFC correction, for example. The only subgroup that's posted a positive in that time has been investors, so consumers with an investment property, and then it was very short-lived. So the consensus is very strongly negative around whether it's a good time to buy a dwelling, and clearly that's an affordability issue. On the one hand, we've seen interest rates jump 4 percentage points. At the same time, we're now starting to see prices passing or nearing their previous peak. So affordability is really a huge drag. But if we ask questions about the outlook for prices, consumers are uniformly positive. They expect, the vast majority expect prices to continue rising over the next 12 months. Again, it's a little bit nuancy. Like if we compare to 2021 when we had the last real surge in house prices, there's fewer consumers that expect prices to really take off. So in terms of the proportion that expect prices to rise by more than 10% over the next 12 months, it's down around 12% of consumers at the moment. Back in 2021, it was about 1 in 4. 25% of consumers thought we were going to get double-digit price growth. So I think even there you've got an element in there saying, okay, affordability is pretty bad. I think prices are rising, they'll continue to rise, but I can't see them going to the moon at double-digit rates. If we look to the labour market's really the last line of defence for consumer sentiment at the moment. When we ask consumers about family finances, ask them about the economy, whether it's a good time to buy, it's all deeply, deeply negative. When we ask them about the outlook for unemployment, though, it's around about long-run averages. So they're not fearful of job loss at the moment. And that's probably the one thing that's holding sentiment where it is and preventing a drop to the really low extremes we've seen during recessions. So it's pretty low at around 80, but we've seen 65 reads on consumer sentiment at its very worst historically. So a lot of that seems to come back to jobs where people don't expect unemployment to decline in the year ahead, but they're still not quite, they don't expect it to rise either if you base it on that average response. So that seems to be still a really important cornerstone. Now that's an area that we're going to be watching very closely because we know the labour market's softening, and we think, particularly as we move into next year, we could see a more material weakening in the labour market and a rise in unemployment, and that could start to spark some job loss concerns for the consumer. And those things, job loss concerns, can often be a catalyst for a more radical change in spending. Putting off big ticket purchases that you don't need to go ahead with because you're worried about job loss. So that area is definitely one to watch going forward, but for now, it's the one thing holding things together. If we don't go through that sort of disruption in the labour market, then I think interest rates on hold, inflation gradually coming back down, we start to see some easing in these cost of living pressures, and sentiment overall might start to rally in time. At the moment, it's not rallying at all. We're still waiting to ride out these whole cost of living issues and interest rates more generally. So, the labour market, I think, provides a really interesting perspective on consumer sentiment at the moment because of these contrasts. Well, of course, we get lots of detail by state, and sometimes that can throw up some really interesting aspects. The one thing that stood out in the October survey is that weakness in consumer sentiment in Queensland suddenly jumped. We went from having consumer sentiment maybe 3 or 4 percentage points behind the rest of the nation. It dropped to being 11 percentage points below the rest of the nation. And while we get a bit of noise in the survey, this is probably an example of that sort of noise. Circumstantial evidence suggests that it might have been some disappointing sports results behind that sharp weakening in the October month, and hopefully that's not something that is sustained or more fundamental.